We know from earlier lessons that diversification is the elimination of risk by investing in different assets. It works by allowing the extreme good and bad returns to cancel each other out. The result is that total variability or risk is reduced without affecting expected return. Asset allocation is similar to diversification, but in a much wider sense. Asset allocation is an investment term that deals with how your money should be divided among stocks, bonds, and other investments. First, investors should be well diversified, generally with holdings in several different classes of investments, such as domestic common stocks, international common stocks, and bonds. The objective is to increase your return on investments while decreasing risk. This is what diversification is all about. No two investors should allocate in the same way. Not all risk is equal. You don't want to do what your best friend Joe does, nor will you want to follow your Aunt Susie's plan, because your age, income, family situation, personal financial goals, and tolerance for risk will certainly vary. These factors will lead you in your own direction. Asset allocation also incorporates the concept of the time dimension of investing. It recognizes that investing in common stocks is more appropriate the longer the investment horizon is, so that investors with more time to reach their goals should have a larger proportion of common stocks in their portfolios. The closer you get to retirement, the smaller the proportion of your retirement funds that should be invested in common stocks. In addition, your financial situation also impacts your asset allocation decision. The less secure your job is, the less risk you should take when you make your asset allocation decision. Asset allocation is the most important task you'll undertake in your investing career. How you go about your asset allocation will have a far greater impact on your return than while choosing each individual stock or bond you hold. Asset allocation is not a one-time decision. Adjustments will need to be made as your life circumstances change. As you keep an eye on your portfolio, you may occasionally need to rebalance your mix to keep the percentage of each investment category in line with your current personal financial goals. If you found this episode helpful, please give it the thumbs up and share it with your friends. If you feel inclined, please like us on Facebook, subscribe to our YouTube channel, follow us on Twitter and Instagram, and if you really want to, subscribe to Gennecho's weekly newsletter. We will give you all sorts of advice, tips, and strategies to all things finance and investing. Just click the link below and enter your name and email in the form provided. Thank you so much for watching and have a great day.